Hi, I'm Jackie Jackson, and I'm going to talk to you about corporate valuation analysis. Now, this is an exercise that typically someone goes through when they're deciding whether or not they want to purchase or sell a corporation. And in order to sell something, you need to know what type of a price you can ask. So there are four main methods that are used: the comparable methods, the discounted cash flow method, the market analysis method, and the multiples method. In the comparables method, what you do is you look at comparable companies and you decide what they're worth, or comparable transactions and how much they were priced at, and then you look at your company and decide what type of a price might be fair. This is a tricky kind of analysis because you need to have comparable transactions to look at. The next type of analysis that can be done is discounted cash flows. And in this scenario, what you do is you project out how much money you think that company is going to make in the future, and then you discount those cash flows back at a specific rate, typically the weighted average cost of capital, which is a blend of that company's cost of equity and cost of debt. The third way that you can look at it is market analysis, in which case you look at the market value of the company by taking the number of shares that the company has outstanding and multiplying it by the market value of those shares. And then finally, you have the multiples approach, which is every investor or every financial analyst has their favorite type of multiple, but some of the more common ones used are the price to equity ratio, or the EBITDA, the earnings before interest, tax, and depreciation expense. And you look at that ratio and you compare it to the ratio of other companies to get a sense of how much that particular company might be worth.